The story of Evergrande is not just about one company's collapse. It's about the unraveling of an economic model that powered China's meteoric rise for decades. To understand why Evergrande matters so much, we need to go back to the beginning and see how China built the largest real estate bubble in human history, and why its bursting could reshape the global economy in ways we're only beginning to comprehend. For the past 30 years, real estate has been the engine of China's economic miracle. When Deng Xiaoping opened up the Chinese economy in the late 1970s and early 1980s, he set in motion a transformation that would lift hundreds of millions out of poverty. But this growth wasn't built on innovation or consumption like in Western economies. It was built on concrete, steel, and glass. Real estate became the backbone of everything. Local governments, which were suddenly responsible for their own financing after reforms in the 1990s, discovered they could sell land use rights to developers and use that money to build infrastructure and fund their operations. This created a powerful incentive. More development meant more money, which meant more development. It was a cycle that seemed unstoppable. Evergrande emerged in this environment in 1996, founded by Xu Jiayin, who would later become one of China's richest men. The company rode the wave of China's urbanization boom, building apartments, shopping malls, and entire communities across the country. At its peak, Evergrande wasn't just a real estate company. It had diversified into electric vehicles, bottled water, theme parks, and even owned one of China's most successful soccer teams. By 2020, Evergrande had become the world's most indebted property developer, with liabilities exceeding $300 billion. To put that in perspective, that's more than the GDP of many countries. The company had over 1,300 projects across 280 cities in China, employing more than 200,000 people directly and supporting millions more jobs indirectly through its vast supply chain. But Evergrande's business model was fundamentally unsustainable, and it was a model that many Chinese developers had copied. The company would buy land from local governments, often borrowing heavily to do so. Then they would start construction and begin pre-selling apartments to buyers, sometimes years before the buildings were completed. This gave them a flood of cash up front, which they would use not to finish those projects, but to buy more land and start more projects. It was a Ponzi scheme hidden in plain sight, one that only worked as long as property prices kept rising and new buyers kept appearing. Chinese households poured their savings into real estate because there were few other investment options. The stock market was volatile and poorly regulated. Interest rates on bank deposits were low, and capital controls made it difficult to invest abroad. Real estate became the primary store of wealth for Chinese families, who often owned multiple properties as investments. The Chinese government watched this bubble inflate with growing concern. By some estimates, real estate and related industries accounted for nearly 30% of China's GDP. Ghost cities sprouted across the country, entire urban developments with empty apartment blocks, unused shopping centers, and deserted streets. Analysts estimated there were enough empty apartments in China to house tens of millions of people. The social implications were severe too. Housing became increasingly unaffordable for young people, with price-to-income ratios in major cities reaching astronomical levels. In cities like Shenzhen and Beijing, the average home cost more than 40 times the average annual salary. This was creating a generation that felt locked out of home ownership, and by extension, traditional markers of success and stability. In August 2020, Chinese regulators introduced what became known as the Three Red Lines policy. These were financial metrics that property developers had to meet to be allowed to take on new debt. The three lines were liability-to-asset ratios excluding advance proceeds from projects under 70%, net gearing ratios below 100%, and cash-to-short-term debt ratios of at least 1. For Evergrande, which violated all three red lines, this was catastrophic. The company had been surviving by constantly taking on new debt to service old debt. When that tap was turned off, the house of cards began to collapse. The first signs of trouble became public in the summer of 2021. Evergrande began missing payments to suppliers and contractors. Construction on projects across China ground to a halt. Angry homebuyers who had paid for apartments that were now half-finished began protesting outside Evergrande offices and government buildings. The company's bonds, which had been trading at near face value, plummeted as investors realized the scale of the problem. By September 2021, Evergrande officially defaulted on its international debt obligations. The default sent shockwaves through global financial markets. Investors worried about contagion effects. Would other Chinese developers follow Evergrande into default? Would banks that had lent to these companies face massive losses? Would the Chinese government intervene with a bailout? And if so, what would that look like? The Chinese government's response was telling. Unlike in 2008 when Western governments rushed to bail out failing financial institutions, Beijing took a much more measured approach. The government made it clear that Evergrande's shareholders and bondholders would face losses. There would be no blanket bailout. However, authorities also worked to ensure that the most socially sensitive aspects of the crisis were managed. They pushed Evergrande to prioritize completing unfinished housing projects so that ordinary Chinese citizens who had paid for apartments would eventually get their homes. They also worked to prevent a complete collapse that could trigger mass unemployment and social unrest. This approach reflected a deliberate policy choice by President Xi Jinping's government. Xi had made common prosperity a centerpiece of his policy agenda, and bailing out a billionaire developer and his wealthy investors would have contradicted that message. The government wanted to deflate the property bubble, but in a controlled way, what they called a soft landing. But achieving a soft landing has proven extraordinarily difficult. Evergrande's troubles quickly spread to other developers. Country Garden, once China's largest developer by sales, also ran into severe financial difficulties. Smaller developers began defaulting on their debts as well. The property sector, which had been the primary driver of Chinese economic growth for decades, contracted sharply. New home sales plummeted. Land auctions that local governments depended on for revenue saw far fewer bidders, and construction activity declined significantly. The ripple effects extended far beyond real estate. China's steel industry, cement manufacturers, appliance makers, and furniture producers all depended heavily on property construction. As building slowed, these industries faced overcapacity and falling demand. Youth unemployment in China rose to record levels, partly because the property sector and related industries had been major employers of young workers. The financial system also faced stress. Chinese banks had enormous exposure to the property sector through loans to developers, mortgages to homebuyers, and loans to local government financing vehicles that derived revenue from land sales. While Chinese banks are state-owned and could theoretically withstand significant losses through government support, the scale of bad debts was concerning. Some analysts estimated that property-related loans accounted for 40% or more of total bank lending in China. Even more concerning was the shadow banking system, trust companies, and other non-bank financial institutions that had lent heavily to property developers at higher interest rates than banks charged. Many of these institutions faced insolvency as developer defaults mounted. For ordinary Chinese citizens, the Evergrande crisis shattered a fundamental assumption that had underpinned the social contract for decades, that property values would always rise and that real estate was a safe investment. Families saw their wealth evaporate as property values declined. Young people who had taken on massive mortgages to buy overpriced apartments found themselves with negative equity, owing more on their mortgages than their homes were worth. Some homebuyers in China even began a mortgage boycott, refusing to continue payments on loans for apartments that were not being completed. This was a radical step in a country where defaulting on debts carries severe consequences, including restrictions on travel, education, and employment. The mortgage boycott spread to hundreds of projects across China before authorities cracked down and worked to restart construction. The international implications of China's property crisis are profound. China has been the world's largest consumer of commodities for decades, driven largely by construction demand. As Chinese property development contracted, demand for iron ore, copper, aluminum, and other raw materials declined significantly. This affected commodity exporting countries from Australia to Brazil to African nations that had become economically dependent on Chinese demand. Global commodity prices fell, and some analysts warned of a commodity supercycle reversal that could reshape global trade patterns. Foreign investors who had bought bonds issued by Chinese property developers faced significant losses. Many pension funds, insurance companies, and asset managers around the world had exposure to Chinese real estate debt, attracted by higher yields than were available in developed markets. When Evergrande and other developers defaulted, these investors had to write down billions in losses. Some Chinese developers had also invested heavily in real estate overseas, from London to New York to Sydney. As these companies faced financial stress at home, they were forced to sell overseas assets, often at fire sale prices, adding to volatility in global property markets. The broader question is what China's economic model looks like without the property sector as its primary engine of growth. For decades, China's economic growth formula relied on massive investment in infrastructure and real estate, funded by debt. Consumer spending was relatively low as a share of GDP compared to other major economies. The government has been trying to rebalance the economy toward consumption and services, but this transition is proving difficult. Chinese households, shaken by falling property values and uncertain economic prospects, are saving more rather than spending. Companies are reluctant to invest when demand is weak. This has left the government relying on traditional infrastructure spending to support growth. But even this is showing diminishing returns as the country already has extensive infrastructure. Some economists argue that China is facing a balance sheet recession, similar to what Japan experienced after its property bubble burst in the 1990s. In such a scenario, households and companies become so focused on paying down debt and rebuilding savings that they cut spending dramatically, leading to persistent weak demand and slow growth despite low interest rates and government stimulus efforts. Japan took decades to work through its balance sheet recession, and its economy never fully returned to its former dynamism. Whether China faces a similar fate is one of the most important economic questions of our time. There are also significant political dimensions to this crisis. President Xi Jinping has concentrated power to an unprecedented degree in the Chinese system, eliminating term limits and sidelining potential rivals. His government now owns this crisis in a way that previous Chinese leaders might not have. If the economic pain becomes too severe, it could undermine the Communist Party's legitimacy, which has been based largely on delivering rising living standards. The party's ability to manage this crisis while avoiding mass unemployment and social instability will be a test of the Chinese governance model. There are already signs of public discontent, from the mortgage boycotts to protests by investors who lost money in failed wealth management products tied to property developers. Looking ahead, the Evergrande crisis represents a turning point for China and the global economy. The era of debt-fueled property development as China's primary growth driver is over. What replaces it remains uncertain. China is investing heavily in advanced manufacturing, particularly in areas like electric vehicles, renewable energy, and semiconductors, trying to move up the value chain and reduce dependence on Western technology. But these sectors, while important, cannot absorb the massive amount of labor and capital that was deployed in property construction. The social consequences of this transition, higher unemployment, lower wealth, reduced expectations for the future, may reshape Chinese society in fundamental ways. For the global economy, a slower-growing China with less voracious commodity demand and more focus on exports of manufactured goods has important implications. It could mean continued deflationary pressures in global manufacturing as Chinese companies with overcapacity at home seek markets abroad. It could mean less demand for the commodities and capital goods that supported growth in emerging markets. It could also mean a more inward-focused China, less engaged with the global economy and potentially more assertive in its foreign policy as leaders seek to distract from economic challenges at home. The Evergrande nightmare, then, is not just about one company or even one sector. It's about the end of an economic era and the uncertain beginning of whatever comes next. How China navigates this transition will shape not just its own future, but the trajectory of the 21st century global economy.